In this video, we're going to be talking about some basic questions that you should be asking a loan officer before you buy a house. There's some questions you need to ask and need to know. The more questions you ask, the better. There are no dumb questions when it comes to loans. Stay with us. Hi, I'm Kevin Todd. I'm with Coldwell Banker Real Estate. I'm here with Max Ballard. He's a Guarantee Rate Infinity. I've written down some questions that I think you should ask all lenders before you get a loan. And Max has been more than gracious to give up his time to be here with us and answer these questions. If you do have any questions, feel free to comment below and we'll answer those and help you in any way that we possibly can. This is Max Ballard.
Hey guys.
Max, how many different type of loans are there?
There are literally hundreds of different loans, Kevin. There's the basic loan types, which are conventional loans, which are backed by Freddie Mac and Fannie Mae. There's USDA loans. There's FHA loans, VA loans. There are other loan types, jumbo loans, which are above the conventional loan limit sizes. And then there are private lenders who offer what we call non-QM loans, might be alternate income documentation loans, things of that nature. So there's literally hundreds and hundreds of different loan types.
Wow, I've never realized there's that many different loans. Do y'all offer all of them?
We do not. We do have quite a few loans that we offer though. Pretty much all the major loan types. We do construction lending, 2 or 3K loans, which is FHA rehab loans, but we don't have all of them. I don't know that any lender has all of them. So it's a good idea to shop around and talk to lenders, get at least 2 comparisons between lenders before moving ahead with a choice of who's going to do your loan for you.
Cool. Well, thank you, Max. Do y'all keep the loans or do you sell the loans?
We do keep a good bit of our loans. Eventually, loans are securities that are sold on the open market. They're traded, and pretty much every lender has some formula of loans they keep versus loans they sell. Usually when your loan gets sold, it's during a time of expansion, maybe for the company that's holding them, because they do get paid money when they sell the loans. But for the most part, we do keep quite a few, but we sell to large investors like Chase, Wells Fargo, Bank of America, etc.
Nice. Max, what is a LE?
The loan estimate you get from your lender initially when you apply for a mortgage loan, and the loan estimate is the best knowledge that we have of what the actual costs of your loan are going to be. Now those numbers could change, and a lot of them will change. Some of those are not allowed to change at all. Some of those numbers can change by up to 10%, but it's the best information that we have at the time of application for what all the loan costs are going to be to the consumer.
Cool. So Max, the different type of loans, how much do I have to put down for different types of loans? I know some of them's 3.5%, some's 5%. What are the different types, and how much would I have to put down for the different types of loans?
Sure. So FHA loans require 3.5% down payment. There are variations on that though, where we do have different housing, first-time buyer programs where you may not have to put down the 3.5%, where that can come from the state or another entity. VA, USDA loans don't require any down payment, so 0 down payment on those. Conventional loans, 3 to 5%, depending on whether you're a first-time buyer or not. Jumbo loans, usually 10% or more. So different down payment types. There's many first-time buyer programs where you don't have to put any down payment down, but rule of thumb, you should always talk to a lender, talk to your realtor, figure out what programs you can qualify for and how much money you're going to have to put aside for down payment or closing costs.
Wow. So you said there's some loans that I don't have to put any money down on?
That's correct. There's quite a few loans, and there's different first-time buyer programs where you get assistance from nonprofit organizations, from state housing entities, different things where they will actually help you come up with a down payment.
Wow, that's awesome. Do y'all offer those loans?
We do. We offer several of those through South Carolina State Housing and through some other nonprofit agencies.
Awesome. So what is PMI, Max? I hear people talk about PMI. What is that?
Yep, PMI is private mortgage insurance, and typically it comes into play on almost all loan types. It does not come into play on VA loans. USDA calls it something different than PMI, but PMI is when you don't have at least 20% down payment. Private mortgage insurance is a risk-based premium. It's based on your down payment amount, credit score, your loan to value. So there's a lot of things that go into factoring how the PMI premium is calculated. The PMI premium historically or traditionally is a monthly payment as part of your mortgage insurance, but it can be done other ways, just like any other insurance. It could be paid in full lump sum by the lender. It could be paid in full by an interested party like the seller. It could be paid in full by the buyer. It could be financed into the loan. So there's different ways to deal with the PMI. And it's good to look at a couple different options to figure out what's going to be best for the buyer in their situation.
So you said I can get a loan without PMI, but I more than likely have to put 20% down?
You correct. For the most part, that's the easiest way to get out of PMI is putting 20% down. You can't structure the loan differently where you have a first and second mortgage to avoid having the PMI. So there's different ways to go about it. And like I said, the PMI insurance itself, there's different ways to not have that monthly in your payment, such as financing it into the loan.
Right. So I hear people talking about interest rate and APR. What is the difference of those two? What is that?
So the interest rate is what determines your monthly payment and your repayment on your loan. That is the nominal interest rate. And when you're using like a payment calculator or anything like that, that is how you calculate the payment. The APR takes into account certain portions of the closing costs and annualizes those over the life of the loan. So usually the APR is going to be a higher number than your interest rate, but the APR is not determine how your payment is calculated or your repayment to the lender. Is simply the internal yield on the loan that the lender makes based on the percentage of closing costs. So it's kind of a fuzzy number. It's one of those fuzzy government numbers that's supposed to be helpful, but more often than not, it confuses folks.
Right.
But
Yeah.
it's always good to look at the APR because that is a requirement of federal law to always post the APR and the interest rate so people can look at those numbers and figure out how high their closing costs are.
Yeah, I've had a lot of clients before, and they get really confused about the APR, and it's very confusing. So the best thing to do is talk with Max or a lender, and he'll be more than happy to explain everything to you.
Right.
So, when you lock, like if you get an interest rate, can you lock that rate?
Yeah, I mean, typically as long as you have a contract on a house, you can lock an interest rate. Different lock windows have different rates, and by that I mean the further out in time you go, the more expensive the money becomes because the lender is having to hedge that against what future uncertainties the rates may move up or down. So if you're doing a 30-day lock versus a 60-day lock, the 30-day lock is usually cheaper. It may be a lower rate or just lower fees and points than the 60-day lock. But most lenders have the ability to lock up to 12 months out in time. So if you're building a new construction house, you can get a lock for up to 12 months to protect you while you're building that house. And then usually you have a float down option within 60 days of closing so that if the market is better than the rate you locked at, you can take advantage of that. So, but yeah, you can lock from day one up to a year out.
Oh, cool. So you did say if you lock at one rate and then the rate goes lower, you can actually go to the lower rate.
Correct.
But if it goes up, your rate won't go up, right?
Correct. You're protected. That's the whole point of the lock is to protect you from future increases.
Cool. And that's a percentage you pay. How much does that cost typically? A rough idea.
It depends. I mean, so some locks don't cost anything, which is called par locks. When you get into long-term locks, which is 120 days or longer, some of those do have upfront fees. There's refundable upfront fees versus non-refundable. So it's always good to talk to at least one or two lenders figure out what their lock options are if you're looking at doing extended locks, and kind of compare the terms between the two lenders.
Oh, cool. So people do 30 years. I personally think 20 years or less you should do, but what do you think on that, Max?
That's going to be different for every single buyer, and it depends on their financial goals. So it's a good idea to sit down and talk to your mortgage lender, and also maybe a financial planner if you have one of those, to try to figure out a long-term strategy. What's your goal? Do you want to pay the house off in 15 years and have it free and clear? You can finance it for 30 years and pay it off in 15 by paying more than what your normal payment is. Doing that is simply is like running an amortization calculator to figure out what you need to pay it off. So having the comfort of a 30-year payment with being able to pay it off in 20 years or 15 years. Like I said, each individual is going to have different goals with how they want to finance their house and finance their payment. But for the most part, I think most of our business is 30-year fixed.
Right.
We see that a lot, unless you get into some retirees and such, putting large down payments down, then they may want to be looking at 15-year terms and such.
Right. I did a house one time and had a bi-weekly payment. Do y'all do bi-weekly payments?
So that is done through the servicing, and typically all servicers will allow you some kind of variation of how to pay, either setting it up online, bi-weekly, like you said, which actually makes 13 payments a year versus 12.
Right.
But that's done through your servicer, and all servicers are different, but most of them will allow bi-weekly payments like that. And depending on your balance, your rate, and things of that nature, you could shave quite a bit off of what you're going to repay on the loan over time by paying one extra payment a year.
Yeah. Now, one extra payment, I mean, you're talking about saving thousands and thousands of dollars, right?
Correct.
Yeah. That's what I always say. Try to pay it off, at least one extra payment a year, if not two. I personally pay 2 extra payments a year on my house, and the faster you can pay it off, the more money you'll save. So you definitely need to do that. I hear people talk about discount points. What are discount points?
So discount points are typically fees that are paid in advance on the lock, and not in advance. You can pay those at the closing typically, but it's buying the rate lower than what the par rate is. So for example, say today's 2.75% on the 30-year fixed is par rate, meaning no points, but you want to get 2.5%. There would be a cost to get to 2.5% today based on the given rate sheet. That cost is what you call discount points, and sometimes it makes sense to do that, sometimes it doesn't make sense to do that. Typically, my rule of thumb is if you're going to pay points to get a lower rate, the points need to pay for themselves within 30 to 36 months of a repayment on the loan. So looking at that payment at 2.5 versus 2.75, take that difference and divide it into the points.
Right.
If it takes longer than 30 or 36 months, my litmus test is don't pay the points. Just go with the cheaper rate.
Right.
But every person is different. Some people have long-term goals, so they know they're going to keep the house for 30 years, and in those circumstances, sometimes it may make sense to pay the points that take longer to break even. But that in a nutshell is points. Is buying the rate down lower than what the market rate is today.
Right, because the average person sells a house in about 5 to 7 years anyway. So by paying if you pay that, and you could be throwing money away, really.
Correct. If you don't break even on those points before you sell the house, then you've truly wasted some money. So.
Yeah, right. So what are origination fees?
Origination fees are typically any fees coming from the lender, and historically these have been called anything from underwriting fees to processing fees to administrative fees, and however they're worded on the breakout. Any fees that go back to the lender are origination fees, and most lenders have some type of origination fees. It helps them cover their overhead for their fixed costs, such as underwriting and processing. You see those range anywhere from $800 to $1,500 on average. Some lenders have a 1% origination fee, which is pretty steep, but it's always good to compare and look at all the numbers. What am I paying? What is my rate? What am I bringing to the table? So if you're comparing 2 or 3 lenders, look at all those fees that are being charged to you on the front end to see what you're getting.
Right, and I'm glad you said that, Max. I always recommend talk to at least 2 lenders, maybe 3. Make them compete against each other to get yourself the best deal you possibly can. And like Max was saying, I've seen some lenders charge 2% origination fee. If you're buying a $300,000 house, 2%, that's $6,000. And if you go with Max or someone that charges, say, $800 fee, that's a lot of money you can save. So definitely talk to different lenders and Max, they do a fantastic job, and they do an incredible job, and you definitely need to talk with different lenders and see.
Absolutely. And back on that fee thing, there are different fees between different lenders on specific loans, and by that, VA loans, we charge no fees at all. We charge 0 origination fees or lender fees to the veterans, and that's one of our ways to say thank you to the veterans for their service. Other loans, such as the state housing, they have their own set of costs where we may have to charge more origination fees than what we normally charge on a loan, simply because of dealing with the state or whatever the nonprofit entity is and their underwriting and their processes.
Right.
So it's always good to look at 2 or 3 different types of loans to, between different lenders and see what you're getting and what you're paying for that service.
Oh, cool. So, closing costs, like, I know there's a lot of different fees involved in closing. Can you tell us what some of those fees are that's in closing costs?
Yeah, so in South Carolina, we're an attorney closing state. So one of the major components of the closing costs is going to be what your attorney is charging. Historically, in other states, they call those title fees. Part of the fees in South Carolina are title fees, and that's abstract work from people going through the courthouse records and looking up all the property information, liens, descriptions, title insurance, which covers the lender against anything that they may have missed in that title search, owner's title insurance, which covers the owner against anything. And we always hear these stories about, I think it was upstate New York, the Massapequa Indians, something where somebody missed that they owned all this land and all these people had to just basically leave their homes. Those that did not have title insurance just lost thousands and thousands and the lifetime of earnings, on these houses that they had to walk away from. So title insurance, attorney's fees, those are a huge component of the closing costs. Your prepaid items, which are setting up your escrows for taxes and insurance, if you're having those escrowed into your loan, those are a good percentage, especially if you're coastal areas like us. Some of the insurance premiums are pretty high on houses because of the hurricane danger.
Yeah.
Closer to the coast, if you're in a flood zone, that can escalate closing costs. Any kind of lender fees that are being charged, which we talked about, the origination fees, those are a percentage of the closing. And then there's some ancillary things, some fixed costs like an appraisal. And those are things that you have to have done, but those aren't necessarily fees that are charged to you by a lender. It's a third party. So depending on the loan types, but there's several different things that comprise the closing costs. And it really, the purchase price is an indicator of how expensive the closing costs are going to be. If you're buying $1 million home versus a $200,000 home, your closing costs are going to be a lot more on the $1 million home.
Of course, yeah.
Right, but like I said, the closing costs, just like origination fees, always compare at least 2 lenders to figure out what that's going to be.
Right. And good thing you said about the title insurance. Make sure your lender the attorney that's doing the title search goes back 40 or 60 years or more even. I personally know someone that the attorney only went back 40 years, and luckily they had the title insurance because someone knocked on the door and said, "This is our house, it belonged to our relatives, they passed away. They were supposed to leave us a percentage of it, they didn't. We were claiming this house." Luckily they had title insurance. That person's title insurance company ended up paying over $900,000 to those 3 individuals to cover the house, so they were able to still stay in the house. You've got to make sure you have title insurance. If you don't take away anything from this video, please make sure you have title insurance to cover your interest in the house. It's very important.
Absolutely. It's a very cheap premium, and if you ever have to cash in on that premium, it's going to be the best insurance you ever bought in your life, for sure. So.
Yeah. Yes, exactly. Max, is there a prepayment penalty?
Typically not. Lots and lots of things changed after the whole 2008 mortgage meltdown. You used to see a lot of loans which we would categorize back then as subprime lending that had prepayment penalties. Today, you really don't see that in most conventional loans, VA loans, USDA loans. There's no prepayment penalty in those. If you are in a unique situation where you have to deal with a lender for what we call a non-qualified mortgage, which may be doing bank statements to document your income versus tax returns or something along those lines, some of those loans do carry prepayment penalties. But always ask your lender and be sure you're understanding what you're getting into with the loans. prepayment penalty, I always ask that question. But for the most part, yeah, it's very rare that you see a loan with a prepayment penalty these days.
Oh, good. Do y'all in-house loans, or do y'all keep loans, or do you sell them? How does that work?
I mean, we do our own internal approval of loans. So we underwrite our own loans, we fund our own loans, we make our own loan decisions. Some of the loans, depending on the size of the loans, they get into kind of specialty areas. Once you get above, say, $2.5 million or something like that, you may be having your loan underwritten directly from an investor such as Chase, Bank of America, some of the larger lenders that do the super jumbo loans is what we refer to them as. But for the most part, we do all of our own in-house underwriting, processing, approving, and funding of loans. And then after the loan closes, we service quite a bit of those. Just depends on the products and whatnot as to whether we're going to service those or sell them off.
Right. So typically, how long will it take to close? If we write a contract today, how long will it take for us to close where the buyers can move in the house?
It's typically 30 to 45 days is a good timeline to give because there is a lot of things going on behind the scenes. A lot of things in the closing process that I can't control and you can't control. The appraisal, like I said, that's a whole different third party. And with the rates being as low as they are right now, we're seeing the appraisers become more and more scarce. With their time, their timelines are so backed up because everybody's purchasing and refinancing and all these things at once. So give yourself at least 30 to 45 days. If you're doing some different loans with down payment assistance, such as state housing, things of that nature, you might want to give yourself up to 60 days because we're relying on some of those guys' underwriting processes, which could take longer timelines.
Right. So it's not actually y'all holding up the process and making it take longer. It's waiting on a third party like appraisal.
Correct. Waiting on title work and waiting on appraisals are the two biggest slowdowns for us right now.
Right. And the market's crazy hot right now, so there's a lot going on, so it can take longer, that's for sure. Now, say I fill out a loan with y'all, do you sell my information to third party people to make some money on the side?
So pretty much everybody has some type of other company they own these days. I mean, we own other companies. I mean, our company jointly, NRT and Guaranteed Rate jointly own Guaranteed Rate Affinity. So there's always some kind of hierarchy in the companies, and they're always subsidiaries of the companies. So, we have our own title insurance, we have our own insurance company. So part of the disclosures that we send out, and I'm sure part of the disclosures that you guys send out as well, this is just food for thought. Anytime you're signing up for paperwork, look and see if there's an opt-out option for sharing information with third-party affiliates, etc. My advice is always opt out of that. And a lot of times people, especially if you're signing up for services online, you kind of gloss over. You don't read all 27 pages. Right. You just click at the bottom and say, I agree. What did you agree to?
Right.
Always look for that blank that says I opt out of sharing my information, and that's probably going to be the safest thing for anybody to follow.
Yeah, and that's one of the best things about coming in and talking to a lender, or seeing a lender in person. They can tell you, look, man, you need to check this box here to opt out, and they'll tell you different ways. You go online, like Max said, you don't know what the heck you sign a lot of times. You check and you might miss a box, and they're not going to point out to you. But if you come in and talk with Max and call him on the phone, he's going to point these things out and say, look, you don't want to do this, you want to do this, don't do that, So he'll help you a lot. But I strongly advise using a local lender, somebody you can walk in their office and put your hand on them and say, hey, man, what's going on? And that's why I like to use Max, because if I call him Saturday or Sunday, he answers phone every time. I've had people use other lenders. They never return calls. It's weeks later, they'll call back and say, oh, I thought my assistant called you, which is total BS. You know better than that. They just dropped the ball. But if you have a local lender, you can walk in there and put your hand on and say, hey, man, what's going on? So make sure you use local lenders if you can. So, Max, is your rate adjustable or is it fixed?
So pretty much everything we have been doing for the past couple of years has been fixed rate loans. I mean, we've been in this great environment where the rates have been low and stayed low. I mean, there was a period in time, I think it was maybe 18 months ago when rates started climbing before all this craziness hit with COVID. Typically, you're going to be doing fixed rates when rates are this low. There's really no benefit to doing an adjustable rate. I have actually seen adjustable rates be higher than fixed rates right now because of where the treasury yields are. Adjustable rate loans are tied to shorter term bonds than the fixed rate loans, and those bonds have been a little more volatile than the fixed rate and longer term bonds. But adjustable rate loans are usually a function of the market when you have climbing interest rates.
Right.
And we're going to see that when we come out of this and recover. We're going to see the interest rates going up in the next 2 or 3 or 4 or 5 years. That's when, people may start looking at adjustable rates again. But for the most part, the fixed rates are the safest, they're the lowest, and that's the best case scenario for most buyers these days. So.
Right. Well, I hope this has helped y'all. Again, if you have any questions, please feel free to reach out and call me or call Max. If you're not already working with someone, he'll be more than happy to help in any way he can and answer questions for you. And even if you don't decide to use him, he's very knowledgeable. He's been doing this forever, and he does not mind helping people. And if you would, please click on these videos here to watch other videos about real estate, and please subscribe to my channel. And again, if you have any questions, feel free to call me or Max. We'd be more than happy to help you in any way we can.
Thanks, guys.
Thank you. Have a great day.